The option chain is where every move begins. It's the foundation of the Phoenix dashboard, showing where real flow builds, how call and put pressure shifts, and which side is in control. Every directional move, whether it develops into a sustained trend or fades into chop, starts with these underlying flows. In this video, we'll break down how to identify tops, reactionary bounces, and true bottoms using the option chain, and how GEX Trend Strength helps confirm when a move is real or simply reactive. Tops form when call sellers establish positions at specific strikes, creating zones of resistance that ultimately stifle further upside movement. In stronger bullish trends, this process can take time to develop and often doesn't appear until later in the session as call sellers gradually absorb flow. On more moderate trend days, these zones may form earlier, effectively capping additional upside momentum. To identify them, look for clusters of 2 to 3 strikes where call sellers are concentrated. These represent coordinated areas of resistance. Occasionally, a single strike with exceptionally heavy selling pressure can define the top on its own, marking the point where momentum begins to stall. Long put buyers can also help confirm these tops. When put strikes begin to see concentrated buying activity at the same levels where calls are being sold, it reinforces the formation of a topping pattern and helps define the likely upper boundary of the trading range. This combination of call selling overhead and put buying at the same strikes signals exhaustion. This establishes the effective cap on price movement, showing traders that upside is likely limited beyond these levels. In this first example, call sellers established an early position at the 66-65 strike. Even as price advanced toward that level, the volume of sold calls continued to build, providing clear evidence of resistance and identifying a zone where upside momentum was likely to stall. As the session progressed, call selling expanded down the chain, closer to current price, effectively tightening resistance and further limiting any continuation higher. Roughly 4 hours after the open, put buyers began to step in, reinforcing downside pressure. In this next example, the market was in a stronger uptrend with a larger intraday advance. Here, the formation of the top took longer to develop. Later in the session, we observed put buyers entering at the 6700 strike alongside some emerging call selling, an early indication of where the top might begin to form. On strong trending days like this, these signals can be partially obscured by aggressive FOMO flows, so it's important to look for subtle shifts in participation that reveal where resistance may start building. By the final hour of the session, call sellers became more entrenched, firmly establishing the ceiling and capping further upside movement. It's important to distinguish between a reversal point and a true established bottom. In bearish trends, where call sellers and put buyers dominate, the high negative GEX nodes often mark the initial point of reversal. These are the strikes where put buyers have concentrated and dealers have hedged most aggressively. These are precise reactionary inflection points where the market turns sharply, often triggering a counter-trend bounce. However, this initial reversal is not yet a confirmed bottom. It's simply where downside momentum exhausts and the first phase of stabilization begins. In this example, we can see that the chain is dominated by call sellers hampering upside price movement. This suggests that the most likely trend direction is bearish. When we see setups like this, we want to look to the put side of the chain to identify possible price targets and reversal points. To do this, we look at negative GEX nodes on the put side of the chain. Ideally, we would like to see a clump of strike together, usually 2 or 3, that would act as the support and reversal point. In this example, we have negative GEX nodes at 6850, 6840, and then 2 strikes at 6820 and 6815. These now become downside targets. As the day progresses, price moves lower, breaking through the single nodes until it reaches the node comprised of the 2 strikes. Here we have reached our reversal point. A true bottom forms only after structure rebuilds. The initial reversal happens at the high negative GEX node, the strike where the sell-off exhausts and price turns. From there, a bottom develops when put sellers step in and begin selling premium, absorbing downside flow around those key strikes. As that support firms up, we often but not always see call buyers join in, shifting the flow from purely defensive positioning to opportunistic risk-taking. Together, put sellers defending below and call buyers engaging above create a defined structure. Downside is cushioned, upside begins to open, and the earlier reversal point evolves into a firm intraday bottom, rather than just a single reactionary bounce. Using our previous example, let's look at how the chain evolved after the initial reversal point. As the session progressed, put sellers began stepping in, absorbing downside flow and stabilizing price. Shortly after, call buyers entered, signaling growing confidence and helping to reinforce the developing base. A reversal can occur quickly, but a true bottom takes time to form as this structure rebuilds. Once that process is complete, the option chain regains its balance, with firm put-selling support established below, creating clear levels that now serve as the foundation for continued strength. When neither side dominates, the market transitions into a chop zone, a range-bound environment defined by call sellers capping the upside and put sellers supporting the downside. This can occur after a strong directional move, when traders on both sides begin selling premium and effectively contain price, or on quieter sessions when no clear directional trend develops. On the option chain, you'll see call and put selling building simultaneously, creating opposing walls of resistance and support. Price tends to oscillate between these zones as dealer hedging activity keeps movement constrained. This type of environment is dealer-controlled and typically produces tight, two-sided action. Upside attempts are met by call selling, while pullbacks attract put selling, keeping price pinned within a narrow range. These sessions are not ideal for breakout trades, but are excellent for mean reversion setups or short premium strategies that take advantage of containment. Recognizing when the chain transitions into this balanced structure helps traders adjust expectations. Now let's look at an example where both sides of the chain are active, with call sellers controlling the upside and put sellers supporting the downside, effectively containing price. In this image, call sellers are established at 67.65 and above, while put sellers have entered positions at 67.30 and below, creating the goalposts that define the trading range. It's important to monitor these levels closely, as any shift in participation can alter the balance. As the session unfolds, we see the downside levels tested but gradually becoming more supportive, while the upside call selling continues to strengthen. By the end of the day, levels on both sides have strengthened and moved closer to price, creating tight end-of-day pin between these containment zones. Now that we've covered how call and put sellers define structure within the option chain, we can move on to GEX Trend Strength. When price begins to push through those sold levels, it signals a shift in positioning and dealer hedging behavior, often tied to a broader reversal in trend. Using our previous example, let's look at how the chain evolved after the initial reversal point. As the session progressed, put sellers began stepping in, absorbing downside flow and stabilizing price. Price then advanced toward the previously sold call strikes, but stalled, as GEX Trend Strength remained below 0.3, signaling that upside momentum was not yet strong enough to overcome resistance. As trading continued, put selling increased and call buyers began to enter, strengthening overall flow alignment and allowing GTS to rise. This growing trend strength provided the momentum needed for price to finally push into the upper sold zones. When a shift is paired with a GEX Trend Strength reading of 0.3 or higher, it indicates that the new directional flow has gained control, transforming the market environment from containment to expansion. Now let's look at a trend reversal where GTS failed to rise, preventing price from breaking through the sold levels. In this image, we can see the early signs of a reversal forming, but there isn't enough put selling or call buying to establish a defined bottom. If a true bottom were developing, we'd expect price to quickly rebound toward the primary sold call levels, in this case around 66.70. For those levels to give way, GTS would need to strengthen noticeably. We can see a bottom did in fact develop, and as price approached 66.70, we look for an increase in GTS that might signal that these resistance levels will fail. Although price briefly breached that level, GTS remained weak, and without sustained strength, call sellers regained control, driving price lower into the close. This example highlights how GTS serves as the confirming factor for whether a reversal will evolve into a sustained trend or fade back into containment. It's also important to understand that these sold levels are not absolute barriers. They're zones of resistance or support, not precise lines in the sand. Price can, and often does, move into these sold strike areas, but once it does, the behavior of price action changes noticeably. Movement becomes sticky and slower as each incremental push encounters dealer hedging and opposing flow. These interactions cause price to grind and stall rather than move cleanly through the zone. Recognizing this change in tempo helps traders understand when the market is pushing into structural resistance or support, and when continuation becomes increasingly difficult without a broader shift in the GEX trend and GTS. The option chain reveals where real positioning defines market structure. Identifying these levels gives traders a real edge by revealing where price is likely to react before it happens. The option chain exposes the areas where positioning creates natural turning points. This clarity allows traders to anticipate movement, structure trades, and stay aligned with the flow that truly drives the market. In this video, we covered how to identify tops, reactionary bounces, and true bottoms using the SPX Gamma option chain, showing how call and put activity defines structure, how reversal points form at negative gamma nodes, and how GEX Trend Strength helps determine whether key levels will hold or break. To see these concepts play out in real market action, review our historical examples in Discord, and check out our other videos where we walk through each component of the Phoenix dashboard and demonstrate how to apply these insights in your own zero DTE trading. This content is for informational and educational purposes only. The concepts discussed in this video are intended to demonstrate how SPX Gamma's proprietary indicators can be used to inform and enhance the decision-making process. Nothing presented here should be interpreted as financial, investment, or trading advice. Trading involves risk, and you should always conduct your own analysis or consult a qualified financial professional before making any trading decisions. Past performance is not indicative of future results.